get down to today's business morning, Tuesday, the 38th of July. I am boosting Omofaye. The half-year earnings seasons driving Nigeria's stock market higher the first trading day, 0.11%. We're now in the final trading days of the month. Okay, so the stocks composite index was up about 0.1% to start the trading week as quarterly and half-year earnings come in some sweet, some very bitter. From big names in the market, consumer and industrial goods, as well as oil and gas, and in agriculture, we have a few of these numbers to chew over within the 1 hour programming. Meantime, the Africa Export-Import Bank, by the acronym Afrexim Bank, has signed a memorandum of understanding, $1 billion mining, agriculture, water resources, among other projects with Zamfara State, using Heritage Bank as the banker to the program. The new deal, according to a statement published yesterday, will help Zamfara State to unlock the opportunities it has in local content promotion, facilitate industrial development and exports. Afrexim President Benedict Orama says, quote, "We are pleased that the leadership of Zamfara State has a clear vision. States should do all they can to maximize the use of the resources they have for the benefit of their people." And team of the Business Week, economists, analysts, trade and finance experts and industry operators agree on Monday that Nigeria needs a cocktail of fiscal reforms, good governance, and better public finance that are cohesive and coordinated to benefit from the new Africa Continental Free Trade Area. The forum, which was organized by a financial derivatives company, focused on policy change that would drive the new Pan-African trade deal and the roles of foreign exchange in regional trade and economic growth. So let's take a quick listen to Amin Marty, who is the resident representative of the International Monetary Fund for Nigeria, and what he has to say about Nigeria's foreign exchange practices and what it means for the state of the economy and the new Pan-African trade deal. Take a listen.
Where is Nigeria today when we're talking about multiple exchange rate and etc.? And I think we have to go back and look at the pattern in the past. It was, let's look at, in 2017, before April, before the INE window, we had a parallel market premium of about 60%. Remember, those of you must remember, I don't know what you follow, but in my office we follow Aboki FX as the parallel rate. And that was 520. In February 2017. At that time, the exchange rate, there were multiple exchange rate windows, but the premium with the parallel market was large. Then the INE window came in. And then, so the central bank here managed through its intervention and this new window to reduce the parallel market premium and to start converging the different exchange rates. But here, let's look at where we are. We have the parallel rate, which is the green line, and the INE window, which is the dotted line. And that's about 360, 61. That is now total convergence between the INE rate, where exporters, investors can go and get the exchange rate at market value. That's where 70% of the transactions are. Now, the good news is that the parallel market premium is zero. Now the challenge is that the central bank is moving towards a gradual convergence, but is not completely unified. We have the wholesale rate that moved closer to the 360. We have a lot of the invisibles and all those transactions that are 357, 360, but you also have the retail rate, which is still at 335, 340. We have the famous official rate, 306.5 for fuel importers. And then we also have customs duties, which are now at 326. So there are different exchange rates that are still there that could still create uncertainty for different actors on where they should operate. But again, let's note here that the convergence is happening and that you do have, and this is no small feat, the parallel rate and what I would call the market rate as represented by the INE window that are converging and that have maintained such convergence. Now what we did is that we also did a simulation as part of our Article 4 and say, well, what happens if the exchange rate stays stable, which means that with the inflation differential in real terms, you have a real appreciation. And what happens if you let the exchange rate moves to reflect the shock? Because we do expect oil prices to go down. And we've seen here that by our analysis, under a more unified and greater flexibility in the exchange rate, which by the way can move both ways, we have growth, cumulative growth over the medium term up about 7%. Now, I want to put a caveat, and when I heard people talk earlier about coherence and coordination of policies, I want to put a caveat here under this scenario, and I'll come back to it at the end. This works and only works if you have structural policies that accompany, so structural reforms in the economy, and a fiscal policy that is also supportive. Mobilization of revenues, use of the revenues for public investment, structural reforms to solve some of the infrastructure. Just having a unified exchange rate is not going to solve the problem, it's not going to get you the growth. The unified exchange rate will contribute to more growth, but it won't be the only solution if the other accompanying factors are not there. So I want to make that point clear, and this is where coordination and coherence are very important. And so when we talk about exchange rate, when we talk in Nigeria, we also have these FX restrictions. So access to FX for a large party of goods are not available in the official market, but you can get it outside if you have other sources of FX. Now, I've talked about the different foreign exchange windows. The official should now note it 306.5, but I'm sure UKJ will correct me. Retail, SMEs, we have the invisible BDCs, etc. I talked about all of those. And then we have the FX restrictions. Well, usually, how does FX restrictions operate? If you have FX restrictions, and if these goods are still needed, then I'm going to put pressure on the parallel market by trying to source myself in FX. So usually what you would see is that you would see a parallel market premium rise and increasing the cost. So far in Nigeria, remember the 2017 experiences where we had it, we haven't seen it more recently because there's enough FX being provided through the windows, and somehow the demand is met. But this is what is happening today. If there is any future constraints or shocks, nothing says that the parallel market is not going to be coming back again. So for a sustained basis and the parallel market premium to be reduced sustainably in a permanent way, FX restrictions should not be there because they are part of segmenting the market. For some of those goods, if somebody needs to import, I think that will come to that. And one, I would say, implication of this, and we've seen this happen with some of those goods, is a slide that I've shown in other settings, which I think is quite telling, and that is, before I go to that, let me talk to you about this slide. So this slide is something that is hypothetical, but is actually not applied to Nigeria today, but would have applied to Nigeria if the parallel market premium was the same as in 2017. And what this slide is saying is that if the parallel market premium was still very high, then if you allowed the exchange rate to converge to that parallel market premium, including for the government to get a higher exchange rate for its revenue, there's going to be more resources linked to that, which, if distributed to, let's say, the 35% poorest households, could lead to an income, to an outcome where poverty rates are declining, and you've seen that for both rural and urban, the inequality is declining, and where GDP is rising. So, because we sometimes associate the exchange rate depreciation only with a negative outcome with inflation, I mean, toward the medium term, that extra revenue can also be used for purposes. Again, this is reflecting the market premium in 2017. There is no market premium today.
Amin Marty, the country representative for the IMF in Nigeria. So what has the central bank been doing and why? Let's take a bit of a reaction hear from Moses Tule, who is Director in charge of monetary policy at the Central Bank of Nigeria, what he said in reaction to some of what the IMF country rep says yesterday. Take a listen.
If you have a temporary exchange rate regime that seeks to achieve the long-run target of inflation, it can solve current problems because monetary policy solves current problems, and in the long run, we expect that fiscal policy will address the structural issues. So, if we have that in perspective, then multiple currency practices, which says identifies here, are very temporal measures that, working with structural policies and fiscal policies, are designed to address certain shocks that the economy is experiencing in the interim, expecting that in the long run, fiscal policy, working with structural policies and monetary policy, would have established a solid framework for macroeconomic policy in line with the literature. Otherwise, just like exactly what we have seen in the more advanced countries, they had the nuances, they had the noise in policy. Up to 45 years, multiple currency practices alone, before eventually easing out in year 2000. Let's quickly look at this other issue. I think that clapping with one hand, we now notice that from the perspective of the IMF, which is a departure from what the IMF agreed in 2012 at the spring meetings. Clapping with one hand, the IMF now tells us that because of multiple currency practices, you have, there is trade deficit, there is high inflation, there is low growth. It means low growth comes as a result of exchange rate misalignment. It means inflation comes because of exchange rate misalignment. It means structural deficiencies come as a result of exchange rate misalignment.
Moses Tule, the director at the Monetary Policy Department of the Central Bank of Nigeria. The conversation yesterday around the foreign exchange market volatility, impediments, and what needs to be done.